Welcome to the Jill on Money Show. This is the program that takes the mystery out of your financial life. And for so many of you, one of your largest assets is your home. So maybe you own one. Maybe you're thinking of trading up. Maybe you'd like to buy one. So for this weekend, I have a very special guest. His name is Bill McBride. He is the guy who writes the Calculated Risk blog. This is a blog that I have been reading for 20 years almost. And he is the man who accurately predicted the top of the housing market in 2005. He also then predicted the bottom of the housing market in 2012. And he's just so smart. So just a few things about this interview that I conducted with him. I did it in front of a live audience, so the audio is a little bit weird. Also, there are times where I'm referencing some charts that you're not going to be able to see, and I didn't really describe them because we had this live audience of people who understood what was going on. So the thing that's so interesting about Bill is that he is not a guy who comes from Wall Street. He was actually a tech guy who was just really interested in the real estate market. He started diving deep, and he has essentially become an analyst that so many people rely on. I just absolutely adore this man because he can sort of sift through all the data and tell the story. So for today, we're going to talk about where house prices are, and we'll sometimes refer to nominal house prices, which is just the number, like what is the price of the house, and then real house prices, which are adjusted for inflation. Today, we have part one of my interview with Bill McBride. Bill, can you talk about the chart that is in front of us, nominal house prices? And I think we started in what year is that, 76?
Yeah. So this graph is based on the Case-Shiller index. Really, a lot of people don't know that the Case-Shiller index really wasn't available publicly until about 2006. But now they published all of the data back to 1976. So this graph shows what happened with nominal prices. You can see the housing bubble in 2004, 2005, 2006, and then the subsequent housing bust. And one of the reasons people want me to talk is because we've had this big run-up in the last few years.
And he's actually a little bit too modest, but Bill first started writing about the housing bubble in 2005-ish. Is that about right?
Yeah, January 2005.
And what led you to make that, besides, everybody saw it. Everybody could see, oh my God, real estate's going crazy. Houses are going crazy. Who in this audience was alive during 2005? It was insane, right? It was crazy. It was The Big Short, but that didn't even do justice to it. What was it for you, one of the few people who called it out a little bit early?
Well, it's interesting. I was working out at the gym. There was a young lady that I would talk to all the time. And she came in one day and she said, hey, I just bought this condo for $400,000. And I happen to know, because of our conversations, that she was making about $40,000 a year. And so my question was, well, how does that work? And so I started talking to her, and she was getting a 1% teaser rate on her loan. And at the same time, there were these guys in the gym. I call them the spiky hair guys. They were all driving these really nice cars, and they had spiky hair, and they were all in their 20s. And so I started asking them what they were doing. They were all mortgage guys. They were all, and they said, hey, you can get any loan you want. So that's what really started me digging into it. And it was pretty grim when you got into the nuts and bolts of what was going on.
So often with housing prices and real estate, we talk in nominal. That's how you get these people who say to you, like, my father bought his house for $20,000. It's worth $2 million now. But Bill, you are very clear that we need to really incorporate real house prices. And when you do that, we see the bubble peak, which was, I guess, 2005?
Probably 2006.
2006. We have a complete meltdown. How many times before the housing bust had housing prices gone down on an inflation-adjusted basis?
Well, even on this chart, it was twice before. House prices nominally haven't declined very much. But in real terms, I think a good example is what happened in the late 70s, early 80s when we had really high inflation. House prices actually dropped, depending on the measure you use, by maybe 10%, 15% in real terms. So, and what that means is people's incomes were rising, even though house prices nominally were pretty flat. And so they became more affordable. Plus, of course, at the time, the mortgage rates dropped dramatically.
And I will say that Bill did share with me that I said, well, what was the rate of your first mortgage? And it was 11.1%?
Yeah. I think I bought my first house in 79, 11.1% mortgage rate. And when I sold it just a few years later, that was a selling point because back then, a lot of mortgages were assumable. Now there's only a few, maybe VA loans are assumable, but back then, so when I sold it, people were all excited they could get an 11% mortgage.
We have the housing market bottom out in 12? Is that where it's like sort of the bottom-ish?
Yeah, late 2011, early 2012.
And was that when you were saying the future's so bright, I need my sunglasses?
Yeah.
Is that exactly what you said?
Yeah, I wrote an article in January 2012. People were still pretty bearish on housing. I said, the housing bottom's here. That got picked up everywhere because people were calling me the grizzly bear of housing. I didn't tell Jill this story before, but there's a lot of people out there that make their living being bearish. And when I started writing my blog, which is called Calculated Risk, I was pretty bearish. So I not only was talking about housing, but I was talking about the potential for housing to lead into a financial crisis. So a lot of people were calling me a grizzly bear and super bearish. When I started turning positive, first on the economy in early 2009, I got a lot of angry emails.
Why? Why would anyone be?
Well, because they thought I was one of a kindred spirit.
Oh, so the perma bears came after you and said, no, we don't like that.
No, it was crazy,
How
actually.
How dare you look at data?
And then when I called the bottom, saying, hey, the bottom is here, and I think that was January 2012, I got another big slew of emails. But on the flip side, in the next 2 or 3 or 4 years, I got some really nice emails. And people say, hey, I finally bought my house. Thank you very much. And every time I told them, I said, I didn't tell you to buy the house. You pulled the trigger. So, and all those people are really happy now.
When you look at that recovery period, so let's go from 12 to 20, what's happening in the housing market? Like, are things sort of resetting and getting more into balance? Is inventory coming back? Because obviously during the housing crisis, for some of you who are younger, anyone who is in construction and home building left the industry. There was no money to be made. They were going broke. They were finding other jobs. They were doing different things. What happened in those ensuing recovery years?
From 2012 to 2020, it was just a perfect time for housing. The builders were very happy. Anything you built got sold. Home buyers were very happy because prices were going up. I think Ivy Zellman called it nirvana for housing.
Yep.
So it was just a really good period. As a matter of fact, I was just sharing with Jill. I said, well, maybe I'll just quit because it's too boring. But the last few years haven't been boring.
No, anything but. So we did have an incredible series of events, that catapulted the housing market to where we are today. So in March of 2020, the economy shuts down. And what's happening in the house? I remember that in the very beginning, people thought no one would buy a house in the beginning of the pandemic, right?
I wasn't really sure what was going to happen. One of the things I really like to look at is housing supply. And actually, in March of 2020, housing supply was going up. Because here in California, you weren't even allowed to show a house. So people couldn't, there was a several-month period where the government wouldn't allow houses to be shown, so you had to, kind of buy them off the pictures. But then we had a couple of amazing things happen. First of all, demographics was great in 2020.
What do you mean by that when you say demographics?
We have a cohort going right into the home buying period. So the millennials, which is the largest generation in U.S. history, all of a sudden are hitting their 30s.
And that was the generation that many people said, oh, they don't want to buy a house. They're never going to buy a house. When everyone says never, you should start thinking, well, that's counterintuitive. Why would never ever be the case in a generation?
Yeah, it's funny. I was on TV, I think in 2012 or 2013, and I said, we're really going to get a boom in 2020, and people didn't care. So I said, okay, nobody cares about what's going to happen 7 years out, but it did happen. And of course, at the same time, we've got a combination of fiscal policy that's very supportive of everybody. People weren't losing that many jobs, especially the home buying people, and then of course the Fed lowered interest rates to zero, and I have a number of friends that have mortgage rates under 3%. So,
and so at that time, so we have like 2020. It's funny. I'm sure that we go back, we look at the data. It's 2020. It's really 2021 and 22 where you start to hear people saying they cannot find a home.
Yeah, well, even in 2020, by the end of the year, housing supply was dropping like a rock. And 2021, 2022, it's just no supply at all. So, now we're starting to see supply coming back on the market. So this is something that, of course, I watch every day. So,
and would you say from the residential market, the key is always going to be supply for the next group of years?
Yeah, well, the thing is, supply and demand works for economics, but demand's always a little bit harder to judge, so I always just really focus hard on supply. And recently I've been looking at months of supply because we have this less than 4 million annual rate for existing home sales, and so we don't have to get back to 2019 levels of inventory. We just have to get back to 2019 or lower or higher, levels of supply, months of supply, and that's probably happening right about now.
And it's interesting because so Bill just mentioned, existing homes 4 million, new homes 1 million-ish, right?
Yeah, something a little less than that. But yeah.
I think a lot of people get confused. I say, well, where is it? Like, aren't there more people? Why are there not more listings? And Bill introduced me to this term called the 3Ds, and I said, why would anyone list their home right now and give up those 3 or 4% mortgages? Why would they do that? And Bill says, oh, well, there's always the 3Ds, which are?
Yeah, well, the 3Ds I actually got from my co-blogger, Tanta. If you haven't read my blog, there's links to all of her writing. She passed away in 2007 from ovarian cancer, but she was a phenomenal writer, a mortgage banker, knew the industry inside and out. And she told me that people always sell death, divorce, and disease. Nowadays, because of improvements in insurance, disease isn't as common a reason, but death and divorce. And then, of course, we added the 4th D during the financial crisis, which was debt. And we're kind of maybe seeing a little payment issue right now in Florida because in Florida, homeowners insurance is a real crisis. It is in California too, but nothing like Florida. And also they're mandating at the same time that all these old condos, because of the condo collapse, they have to bring their maintenance, all the deferred maintenance has to be taken care of. So they're having special assessments on the owners. And a lot of people in Florida, their homeowners insurance is more than their mortgage.
That's insane. Who thinks this is a good time to buy a house? Who thinks you're insane to buy? So who thinks, like, if you have the money, you run the numbers, go buy a house? Yes or no? All right. And who thinks this is a terrible time to buy a house? You're nuts. Bill?
Well, I'd be in the first group. I think housing is really hard to time. The only time in my entire career that I told people do not buy was in the late 2004, 2005, 2006, even 2007 period. To me, you're going to get a much better price because of all the distress sales that are coming on the market. Today, if you are out looking for a house and it makes sense, it's not on a busy street, you're going to live there for 5-7 years, it makes sense financially. I don't see it as a big problem. You shouldn't be expecting large appreciation, but that's not really why people buy a house.
Yeah, and I just want to talk a little bit about where we are with affordability, and this is maybe one way to sort of couch that, which is obviously with prices up, I guess, by about 50% since before the pandemic, and inflation's up, or prices are up generally by 22%. So house prices are growing about 2.25 times the pace of inflation. So why should we buy? If I'm looking at this, I'm like, wait, maybe I should rent.
Like I say, I think it's really hard to decide that.
Yeah.
One of the things I've been arguing is, first of all, we have this great graph. We see this huge bubble in the middle. But if you're comparing to the housing bubble, the current situation, that's not the right comparison. In the housing bubble, we had really loose lending, and we got, like the lady I was telling you about that had a 1% a teaser rate. I think she had it for 2 years. And then I go, what happens after that? All of a sudden she can't afford her house. But so we had this flood of distress sales, and that's what really drove down house prices. So that didn't happen this time. Now all these people have tremendous equity, so we're not going to get a flood of distress sales. We may see prices drop in some areas, like I was talking about Florida. We're seeing some price drops there because of particular reasons, the homeowners insurance, which is related to climate change. But we're not going to see a flood of distress sales. So this is more like that 1980 period. This is much more like that. And so what we should kind of experience is somewhat flat nominal prices, maybe some slight increases, slight decreases. It'll just kind of stay there for a while, and that's where it shows on the real prices how after that period, it just kind of went down and then moved sideways for a while, and that's kind of what I expect this time.
I think that a lot of people here have their clients, they're coming to them and they're saying, well, should I just, buy a house for my kid? A lot of their wealthier clients especially, and if you have a young client, I think the messaging here is, hey, you know what? You can buy a house, just make sure the numbers work. Make sure that you have confidence that you can support the payment. But how should people factor in this crazy insurance or even taxes, which are likely to go up in many areas?
Well, you want to look at all expenses. So, if you're buying a condo, you want to know what the homeowners insurance, the homeowners association fees are. You want to know if there's deferred maintenance. Right now the lenders are really tough on condos because of that. If you factor all of the costs in and it makes financial sense to you, I say go ahead. If it doesn't, then don't. Right. And I always caution people, and I'll say it again, don't buy a house that is in a really bad neighborhood. Don't buy a house on a big street. Don't buy a house with a layout that you absolutely hate, because you're going to hate it for the entire time you're there. So, I would never do that. But if you like a house, it's in a neighborhood that you're very comfortable with, and it makes sense financially, I don't see any problem buying now.
So if you had to describe your sense of where we are in housing today as we, come into the last quarter of the year, you're not a perma-bear. Are you bullish? How would you characterize yourself?
Well, I'm definitely not bearish. I'm not a super bull like I was in 2012. I do think the home builders should be okay. This whole sequence has actually been somewhat good for them, because there's no existing supply, or very little existing supply, competing with them, and home builders have tools. They can buy down the mortgage rates. There's this pretty well-known 3-2-1 program where they buy it down for 3% the first year, 2% the second year, 1% the third year. And then, of course, they were always telling people, buy the house but don't date the rate, so that they'll be able to refi in a few years. For the existing home market, I kind of expect that we'll be moving a little bit back towards normal, but it's going to take some time.
How much time? I'm going to make you just tell us exactly so I don't have to think about it.
Well, that brings up a really interesting issue. Is my generation will, if my generation follows my parents' generation, a certain percentage of them will start looking to move to retirement communities. Probably, there's nothing monolithic about any generation, but probably around the age of 80. The middle-aged boomer is 70 right now.
The middle-aged boomer is 70? Wow. I did just to say it like that. That's interesting.
So we might, when you're asking that question, we might actually see more inventory coming on from the boomers later this decade or the beginning of the next decade. There's my 7-year thing that everybody will ignore again.
No, this is for the record. We've got this.
Those homes will tend to be older, because older people tend to live in their homes a long time and not well maintained at the end. But on the flip side, they're going to be in really good locations. So they're going to be close to where people want to live. So, we might see an interesting phenomenon here where house prices are somewhat flat for an extended period.
Okay, that's it for the program today. If you've got a question about real estate or anything else going on in your financial life, give us a holler. Go to JillOnMoney.com, click the Contact Us button. Of course, let us know if you'd like to join us on the air live. And as you will probably hear us talk about in the days and months ahead, the real estate market, it is in transition. So be smart about this. Give us a holler to talk about your specific situation as it applies to what's going on today. Just go to JillOnMoney.com, click the Contact Us button, check the box if you want to join us on the air live. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. Please leave a rating and review wherever you listen. And of course, try to lift someone up. Change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.